So we're going to go ahead and get started. My name is Jennifer Young, and I'm with University Credit Union in their mortgage department. And we are really excited to be back doing our training webinars and our training series. And today we're going to be covering construction loans. And I just want to make sure that I cover a few things up front so that you know exactly what information we're going to be covering. First thing is the construction loans that we're talking about is if you're going to be building a custom construction home. If you are have the land or are looking at buying a piece of property and you need that instrument, that construction loan to get that home built. If you are buying a home through a builder or a developer that is under construction in a tract or something like that, they provide that construction loan. So you don't have to worry about that type of a loan to get the home built. Likewise, if you are looking at building a commercial type property, those construction loans are offered through our commercial department. So for an investment type property or something like that, those would be offered through our commercial department. So that's just to clarify first. We're going to do a real high level flyover with this presentation. This is going to be just kind of basic information. And I will encourage you, if you have more questions, first thing, if you have questions through the presentation, type them in on the question bar because I'm going to try and cover information pretty quick. And the length of this is going to be dependent on how many questions. If we have a lot of questions, it might take a little bit longer, but I respect your time and I want to make sure that we are presenting information and sticking to the topic and covering. So if you have questions, ask them. You can also refer to the number on your screen, the mortgage department, 801-481-8840. That will go to any one of our mortgage consultants and they can answer any of the questions that you have on construction loans. But like I said, type those questions in. I love the questions. Our last presentation, we answered questions for about, gosh, 15, 20 minutes. It was crazy. And there were more questions. We finally said, you know, okay, we're done. But I'm going to jump right in and I'm going to start. I'm going to tell you that throughout the presentation, I'll stop periodically and we'll address some of the questions that have come in. But we're going to go ahead and get started and jump right in. So construction loans, when, why, and what kind? University Credit Union offers a couple of different construction options. We offer a one-time close and a two-time close. And each of those loans have a specific reason for being offered. A lot of people have asked about the one-time close, and that would be typically something that you would want if you're nervous about what the interest rates are going to be at the end of construction, and you really want to try and lock that in up front. That one-time close product offers you that option. The one-time close is limited to conforming loan limits. And so those loans that are within the county loan limits or lower, if you get into the jumbo products and the jumbo loan limits, then you're looking at the only option is a two-time close. We do not offer a one-time close on the jumbo loans. And so that just gives you, there's a couple of different options. We're going to cover briefly each of those. We also offer the opportunity if you are currently living in a home and have decided that you want to do a major remodel or a major renovation. The construction loan is the instrument, the loan that we would use to help you accomplish that. And typically, we just use kind of a limit, typically somewhere around that 50 to 75,000 and above. If you're going to be doing a renovation that's going to be in excess of that, typically it's better to use the construction loan to help you through that, where you're going to be changing walls or changing even square footage. Those types of renovations would be handled under a construction loan, and it would give you the opportunity to be able to go off of anticipated or a future value of the home after all of those improvements are done. And that's what a construction loan would help you through that scenario. So there's just a brief overview of those, and we're going to dive into the different types. But before I do, here we go. We're going to jump in and answer and see if there's any questions that we need to address before we move forward.
Let's see.
And I have James from marketing helping us. So James is going to be our helper today.
Hi, everyone. Let's see. So Devin asks, do these loans also apply to adding on to an existing home or only building a a new home.
Yes, and so I think we answered that, and hopefully, Devin, that answered your question, that if you are doing a major renovation and adding on, changing square footage or anything like that, this would be the product that you would want to work with. Hopefully that answers your question.
Great. Is there this is from Bradley. Is there a pre-approval or do you have the job bid then present? Let's see. You have the job bid then present to the bank?
Okay,
Present.
so that's a really good question, and that was from Bradley. We would pre-approve. We like to start talking to you as early as possible. And so what we would do is we would have a conversation with you, and you would come to us and say, gosh, Jennifer, we're looking at potentially building a home on this piece of property. We've already purchased the piece of property, or we're looking to purchase this piece of property. The property is going to cost $250,000, and the home we think is going to be $500,000. So the overall projected budget of this is $750,000. We think that appraisal value will be that or more. Do we approve? Do we apply, or do we qualify for that? And we would run through that scenario with you, tell you exactly how much you would have to have into it, and if you're approved to be able to do that. So we like to have those conversations as soon as we can. It can be before you've already done all of the bidding and put together that cost breakdown. Sorry, I'm tongue-tied. But before you have that cost breakdown, and it might be beneficial for you because then you would know what you do qualify for and be able to stay within that purchase price or that price range. So hopefully that answers that question. That was a really good question. Thank you.
Jeremy asks, do you provide these loans out of state or just within Utah?
Oh, those questions always kill me, the out of state thing. I am so sorry, but we only stay within the state of Utah. We would love an opportunity to talk to you and see if there was options, maybe if you own your current home, and we could leverage that to give you the funds that you need. But currently we are only doing construction lending and long-term lending in the state of Utah. And that just pains me to say that. Sorry about that, but yeah, I wish.
Bradley asks, we are looking into doing a barn dominiums. Are they a typical loan? We own the property outright.
They're pretty cute, but I will tell you that the only condition is that it meets Fannie Mae guidelines, so that the long-term loan, that we're able to place a long-term loan on that. My suggestion is you call and have a conversation with one of our mortgage consultants at that 481-8840 line. They're going to be able to ask you more specifics about the type of home that you're building. There's pole barn homes and the barn dominium. I know what you're talking about, the barn dominium and those. It really depends on what the finished product, if it's going to fall within the guidelines of Fannie Mae to do a long-term loan on it. If it does, then we're in like Flint. We're ready to go. If not, then we're not going to be able to. But that's a really good question. Thank you for asking. Okay, we're going to take about one or two more questions and then.
Yeah, he asked, can I simply just come in and meet? And I think the answer is yes.
Yes.
Or call the number.
Call the 481-8840 and set an appointment, and you can either come in or we can have those conversations right over the phone. That's great. That's great.
Did you want one more?
Yep, one more.
Let's see. A team, he asks, I missed it. What did you say about Reno that is less than 75K? It would be removing a wall. Oh, Reno.
Okay. Okay.
Mostly kitchen update.
So the rule of thumb for if a construction loan is going to be the right instrument, the right lending instrument for you, is about that 50 to 75,000 mark. If it's under that, then typically a home equity line would do the job for you. But if it's going to be a significant change to the overall value of the property, and if there are going to be structural changes, adding square footage, changing, knocking walls, changing things like that, then typically you would want to have a construction loan involved, because the construction loan, the way that the construction loan works, the disbursements and inspections and making sure that the work is going to be performed is going to be a better instrument for you to use. And when in doubt, I know I've said this already a lot, you guys, so far in the presentation, I'm sorry, but when in doubt, give us a call, because those are pretty specific questions. Those are great questions, but they're very specific to your situation, and it'd be better for you to have a conversation with one of the mortgage consultants. So thank you. Those are amazing questions. We're going to move on. So high level overview of the one-time close. You close on the construction loan and the long-term all at once. So it's one closing. What happens is, if you choose a term of construction, say you decide it's going to take you 9 months, we offer construction loans in 6, 9, and 12 months. If you decide that it's going to be 9 months and you choose, so we do a construction term for 9 months. At the end of the construction term, we're going to have you sign a modification agreement that just modifies it from the construction term to now to the long term. The home has to be 100% complete. During that construction period, you've been making interest-only payments. So now we're going to modify it, and you're going to start making those long-term payments. That long-term can be 10, 15, 20, and 30-year terms. The long-term rate is locked up front. So when you sign those documents before the home is started, we actually commit and lock that rate for the long-term loan. And you have one set of closing costs. So you have one set of title fees and one set of the origination and all of the miscellaneous lender fees, your appraisal credit, all of that stuff. All of those things are done and collected when you start at the close of the very first. So you close on the construction long-term. It's all one set of documents. And this is, I promise you, it will make more sense as we go on. The benefits of the one-time close are exactly that. You're locking the interest rate up front and you're paying one set of closing costs. But at the credit union, what we've tried to do is we've tried to give you that same benefit on the two-time close. The difference is on the one-time close, if you cannot finish that home during that term that you've originally committed on, the commitment for the long-term rate goes away, and you do have to pay for any extensions, and you're subject to what the market rates are. So there's some risk involved there if you're worried about being able to finish the job in the time frame that you've committed. Okay, we're going to move on to the two-time close and just kind of do a high-level overview of the two-time close. And then I'll address, there's questions coming in, and then I'll address the questions. So the two-time close, you close on the construction loan, and you'll notice in our presentation how it says prior to beginning construction. This is where I'm going to tell you, don't start anything on the property before you've had your deed of trust recorded, before you've closed on the construction loan and that deed of trust is recorded. Anything that happens on the property prior to that point would be looked at as a broken lien, a broken priority, and that means it's going to take more work for the title company to get us in a first lien position, and that's what we do, and that's what we require. If you have a buddy that's an excavator and they're going to go out, they're going to go through and they're going to level the site for you and it's going to save you $5,000. That's great. Don't start until after the construction loan is closed. We have so many people that come to us and say, but I just want to get started to save time. I understand. In the state of Utah, we have what's called the State Construction Registry. And if anyone does any work, if they provide any products or anything, they have what's called a right to lien the property. They file what's called an intent to lien. And it's just basically saying that they have provided or they have done whatever and they have a right for payment. If you have anybody that comes and works on your property, they have a right to do that, and it inhibits our ability to get a first lien position. It's not impossible. I don't want to scare you, but I want to emphasize, don't start construction until your construction loan's closed. So back to the two-time close. You close on your construction loan prior to beginning construction. After the home is 100% finished and we have a certificate of occupancy from the city, then we close on the long-term loan once it's complete. The long-term rate is not locked in until the home is complete. We do not lock our loans until we have that certificate of occupancy. We want to make sure that the home is 100% complete. And just a side note, you can actually get a certificate of occupancy without flooring. Go figure, right? You can get it before the home's actually technically 100% complete, but we won't lock it until we have that CFO. That just tells us you're that close and we're ready to go ahead and move forward with the long term. And then in an attempt to help offset some of the expenses, the credit union gives you back 0.5% towards your long-term closing costs. And so we've tried to help mitigate some of those expenses. This product, this 2-time close, is best typically for those that have kind of an unknown of what the term is going to take to build the home, that aren't so much concerned about where the market is going to be on long-term rates, and fall into the jumbo category. If you're in a jumbo category, this is your option, the 2-time close. We do not offer 1-time close on construction loan, or on jumbo loans, sorry, on jumbo loans. So we're gonna jump over some questions. James, what questions do we have?
Okay, Jeremy asks, let's see, are we going to talk about how much down payment is required on construction loans?
We are going to cover that. That's a good question, Jeremy. And I promise to you, we are going to cover, the next thing we're going to cover is lot loans, and then we're going to jump in and we're going to talk about down payment requirements and that. So I will address that. Next question.
Jose asks, do you also help us find the location we can build homes, or would we need to find the location and where the home would be built?
You know, Jose, I would love to come out and go for a ride and find those. I actually do that quite a bit, but my thing when I'm out looking is typically going out to find builders to work with. So we don't. It's up to you to find, you know, what area you like to live in, or what area you are anxious to live in and build a home. That's a very personal thing, so we leave that up to you to decide. But that's a really good question. Thanks for asking.
Derek asks, if I already have a Heloc on my home, can I still qualify for a home construction loan to complete a remodel or renovation?
You can, and you know what, Derek, thank you for addressing that. So here's what happens when you have a current loan, and you even have maybe two. You have a first mortgage and you have either a fixed rate second or a Heloc or something like that. What happens is we're going to base our decision based off of what the home is going to look like after all of the construction, after all of the remodel, after all of the renovations. And so we're going to base it off of what the existing site value is, and then what the home's going to be worth after. And then at the very start, we're going to pay off the mortgage and any subsequent liens. So a Heloc or a fixed rate second or something like that. We take a first place position, and that construction loan, the first advance on that would be to pay off those mortgages. And then the additional funds that you would need for the renovation would be available to you for the rest of the loan. That was a really good question, and I haven't had a question about subsequent liens, so that was a good one. Thank you. So let's talk about lot loans for just a minute. We do offer lot loans. They are an internal product. We do those on a 30-year amortization, so that's what your payments are figured at. But it does have a 3-year call, or a 3-year, some people call it a balloon. In 3 years, it becomes due and payable. These lot loans are not meant to be long-term loans. They're meant to give you an instrument, a tool to use to acquire the property, make sure that you've got it, get the cost breakdown put together, get a set of plans and a cost breakdown and a builder lined up, and be able to move forward to building on that property. We really don't have a product for long-term financing on lot loans. On the lot loans, we require a 20% down payment. So we'll do 80% of loan to value or cost, whichever is most restrictive. There have been a lot of scenarios over the past 18 months, 12 months to 18 months, where people have been paying over appraisal value. You need to know that we will base 20% based off of which is lower. So if you have a purchase price of $100,000 and an appraisal value of $80,000, we're going to start at $80,000, and you're going to have to come up with a down payment plus that extra span between the purchase price and appraisal value. That's probably as clear as mud, but just know that we're going to base our loan amount off of whichever's lower. So make sure that you figured that when you're figuring numbers. And we're interested in financing improved lots that have year-round access. We get a lot of calls for vacation properties and resort type properties. And if they don't have year-round access, then we are really not interested. We want to make sure that you guys, sorry, stutter there, that the roads are improved, that you have snow removal and maintenance and stuff like that. those are things that are really important to us. We want to make sure that that type of property. If you've got a property that's outside of those boundaries, then give us a call and let us see if we can't work something out. But those are typically what we're looking for. So lot loans, 20% down, 30-year AM, 3-year call, figures your payments so that your payments are low so that you can get the rest of it figured out and get a construction loan going. Any questions on those before I move on to?
We have just one from Mark. If work is done before the construction loan is closed, but that work is paid for in full, does that complicate the credit union's first position on lien laws?
So, and it's Mark. You know what?
Yeah.
That's a really good question. The answer is yeah, it complicates it a little bit. It's not impossible, and I don't want to scare you away. I don't want you to but what I don't want to have happen is I don't want you to think it's okay to go ahead and get going well into the construction and that things, there's, you know, a bunch of intent to liens filed and the title company has a problem with the lien position. I want to make sure that you're clear that if things are taken care of, if the work is done and the things are paid and that there are not the intent to lien or we can get releases on those, we're going to be just fine. But it is easier and less complicated and less delay if we just have you wait until we get the construction loan in place. And we will move heaven and earth and try and get it through as quickly as possible. But just know it's just easier. I hope that answered that question. But I appreciate you asking on that one, because I know I kind of scared some people last presentation. They were like, crap, can we still? Yeah, you can still do it. It just complicates it a little bit. So, but that's a really good question. Okay, so the question was, what will we lend on? What are the lending restrictions? So just a few high-level overview on the construction loan specs. The interest rate right now on our construction loans is 3.49%. It is a low rate, and the interest, the way, sorry, frog in my throat. The way that the interest is billed on construction loans is interest is charged on the funds as they are drawn. And so at the very beginning of the construction loan, it's going to have a lower amount because we haven't paid a whole lot. We're only paying maybe for a few things, maybe some deposits on, you know, for deposits on cabinets or deposits on the lumber package or, you know, some of the just initial deposits. And so it's going to start out at a lower amount. And so the interest is only going to be calculated on what the outstanding balance is. And as things progress, as the home progresses, more subcontractors are paid, more of the deposits, more of the generals are going to be paid, and so the loan is going to increase in balance. And so through the course of construction, you have to be able to handle those interest payments. We offer 6 months, 9 months, and 12 months bill terms. And we will go up to 95% of value or cost, whichever is most limiting, if we are in conforming amounts. And here's the caveat to that. If we are in conforming amounts, which are county loan limits, then we'll go up to 95%. If you go over the county limits and are into a jumbo loan category. So just to give you an idea, Salt Lake County is 600,300. If you go over the 600,300, then you fall into a category of jumbo, and we require a 20% equity position in the jumbo category. So we will do 80% of cost or value, whichever is most limiting. And I know that a lot of people had questions on this and that. The best thing I can tell you is give us a call. If that's confusing, give us a call. But just think in your minds, most limiting scenario. But if you're under those county limits, 95% of cost or appraisal value, whichever is most limiting. Okay. It says on here loan amounts up to $2.5 million. And I just want to clarify, we've had a lot of requests over the past couple of years that are well over that $2.5 million mark, and we are interested in those. It's just we like to look at them on a case-by-case basis because The jumbo market is a tricky market, and it is something that we actually keep on our portfolio. So we want to make sure that we have a really good position on those. We are interested, if it goes much over 2.5 to 3 million, then we might switch it over to our commercial department. But we are interested in those. We just have to look at those on a case by case, and that's why the caveat's there. And then primary residence and second homes. At this time, all of our investment properties are handled through our commercial department. And so if you have requests that fall in that category, give us a call. We'll push you over to our commercial department. But for primary and secondary homes, we're able to meet that. And then I'm going to address also, while we're on this, I did have a lot of questions this last presentation. Do we do duplex and fourplex, duplex, triplex, and fourplex? And the answer is yes. Yes, they do fall in this category. And if you are going to be occupying one of those units as your principal residence, then we would be able to accommodate that request through this department. If not, then again, we do have options for those. We just would refer you to our commercial department, and that would be great. Okay, hopefully that answered some of the questions that we had before. And this is just at a glance, the comparison of the one-time versus the two-time close. Again, high-level overview, one time, close once, lock it, your rate for your long-term financing is locked up front. The loan amounts are restricted to the county loan limits. You have one set of fees, you have one closing, you'll sign a modification after the construction. The construction rates right now, 3.49. After that construction period is done, we'll do a modification and you'll be off and running to the long-term loan, whatever those long-term, whatever you agreed on the long-term, whether it's 10-year, 15-year, 20-year, 30-year, that's your choice. Versus the two-time, which you close on the construction loan before the home is started. You go through the draw process and build the home. Once the home is 100% complete, that's when you would close on your long-term. You would sign all of those documents that you are kind of customary to seeing, whether purchase or refinances. Those documents are what you would sign once the home is 100% complete. The loan amounts can go upwards of $2.5 million. Anything over $2.5 million, we would refer you to our commercial department. So that just gives you a high-level comparison and a high-level overview. I'm going to answer questions before we go on to the process.
Let's see. Genevieve asks, do you consider the equity on the lot as part of the 20% down payment?
Thank you, Genevieve. That's a great question. And yes, if you have purchased the land and you have a said equity position, yes, that can certainly be used as part of your down payment or part of your investment. We look at it as the overall investment. So if you've got 100 or 200 or 300, whatever equity in your land that you've already owned, we will use that and put that towards the overall down payment. Yes, it's a great question. Good job, Genevieve.
Next, Russell asks, how difficult is it to get a construction loan if you have limited income but assets?
That is a good question. You have to be qualified to cover the expenses, whether it's a construction loan, whether it's, and you know, I'm going to clarify something. So construction loans, I didn't say this last time, and I totally should have. So construction loans are a big risk. It's probably one of the single biggest risk loans that institutions, that financial institutions do. And so the first thing that the financial institution is going to say is, if we walk into this construction loan, if we walk into this proverbial door, how are we going to get out of it? How are we going to get out of this construction loan? The answer is the long-term takeout, the long-term loan. And so in answer to your question, we have to be able to qualify you for the long-term takeout, because the construction loan is only good for 6 months or 9 months or 12 months, whatever the term is. It's really only good for that short term to get the home from dirt to structural. Once it's built, we want to convert that over to the, and we qualify you for the long-term takeout in addition to the construction loan. So hopefully that answers. If you have limited income, we're going to require that you have enough income to support and be qualified for this type of a product. So hopefully that helps. Hopefully that answers the question. I'm going to run through the process just to give you, again, high level, I keep saying that word, high level overview, but just to give you an idea of what the process is. First thing you need to know, you need to have a general contractor. We really, at this point, we really are not interested in doing owner builders. The main reason for that is we really want this to be a great experience. We want experience on the site. We look at the general contractors and we look at them the same as we look at you. We evaluate their performance. We evaluate their relationships that they have with suppliers and subcontractors and previous owners. We look at every aspect of the general contractor's background to make sure that we're getting you into a situation that it's going to be a successful experience. And so we really ask that you have a general contractor. Now, I say that, and there's always that little caveat, but if you are currently in the industry and you are a licensed contractor of whatever division, and you're interested in building your home and you have experience and we can document, we can show that experience, give us a call. We would love to have that conversation. I don't want to penalize people, but I want you to understand we're asking for you to have a general contractor for your own protection. We like to have that extra insurance on the property or on the project, and making sure that, you know, workers are covered and that it's handled professionally, and that you're not going to have, at the end of this, you're not going to have a lien disaster on your hands. So, second, we gather a whole bunch of documentation from you. We gather all of the income documentation. We gather the set of plans, and the cost breakdown and the contract between you and the builder. And then we do the same from the builder and gather all of his information. We gather licensing information and insurance information. We get a background and make sure that we check his credit, make sure that they're doing what they're supposed to be doing. We evaluate all that information. And once we evaluate all that information, we issue what's called a preliminary loan approval. And that just basically tells you that you're good to go, that you are good to go and move forward with what you're talking about, that everything looks good, that you're qualified for that amount. Next slide. You're qualified for that amount, and that we've evaluated all that information. If we have, at that time, if we have the cost breakdown, a set of plans, and a contract, we'll go ahead and move the file forward and order the appraisal and title. The appraisal and title typically take about 10 days to 2 weeks, maybe a little bit longer than that on the proposed construction, because the appraiser actually is going to go out to the site and they're going to appraise the project subject to completion. Once we get all that information back and we've evaluated that information, it gets sent off to underwriting. We issue what's called a final loan approval. And at this stage, we're ready to go ahead and schedule the closing. The closing is scheduled with the title company. You sign your documents, and I would love to tell you, I'm going to teach you a little bit. I would love to tell you at this point, you're ready to go ahead and start construction, but you're not. What happens is once the title company signs has all the documents signed and everything is done, they physically go out and inspect the property to make sure that nothing has been done. So it's really, really important for you to understand there's usually about a 2 to 3 day delay from when you sign your deed of trust until it's formally recorded and we have a first lien position. The title company is required to check the state construction registry. They're required to do an inspection, a site inspection, and those things just take time. Sometimes they move quicker and sometimes they don't. We usually tell people 2 to 3 days, but just know that once they finish, then they go ahead and notify us that the deed of trust, that's when we congratulate you and say, we're ready to go, you can get things started. All of our draws are handled internal. They're handled by our loan administration department, and those draws are handled and coordinated through that department and the general contractor and you as the homeowner. Each of you is actively involved, and you should be actively involved through that process. You should be involved with your general contractor to see that the job is progressing and that things are being done. You should be on site. You should see it often. I always kind of tease people a little bit and poke fun a little bit at people that are building a home and they haven't been out to the job I've talked to people that haven't been out for 2 or 3 weeks, and I'll tell you that when my husband and I built a home, I think I was out there almost every single day. I couldn't even hardly stand it. It's an exciting time. It's fun to see your dreams come to fruition. Building a home is not for the faint of heart. It's a lot of work. It's a lot of stress. But it is an exciting time. And so we hope that you'll work closely with your builder and with the loan administration department. So at this point, I'm going to stop because we've covered how there's conversion. We've covered that if you've done a one-time close, then after the home is 100% complete, then you would already you would sign a modification. We'd convert it over to the long-term. If you've done a two-time close, once the home is 100% complete, then you'll do the conversion over to the long-term and sign the long-term documents at that point. What I haven't talked about is I just lost my train of thought. What did I miss in there? I just lost my train of thought. That's what I get for thinking ahead of myself. There was something else, dang it, and I'm going to remember it, and then I'll come back and I'll say, okay, wait a minute. Okay, so we'll move on. There are some do's and don'ts. The do's are really easy. Be involved. Check with your mortgage consultant before making any changes. If you have questions and you've decided that you started out and didn't want to finish the basement, but now it's just going to be another, talk to your mortgage consultant to make sure that anything that you're going to be doing, that we can get you qualified for the long-term takeout and it's not going to impact that. Keep in touch with the builder during the construction process. And here it is again, contact your mortgage consultant with any questions. If things are going to come up and you're going to have a lot of questions, but just reach out to the mortgage consultant and talk through it. We're here for you. We're advocates for you. We want to make sure that we're doing what we can to help you through the process. Just like there's a list of do's, there's a list of don'ts. And I've said this a couple of times and I'm going to say it again. Don't start construction before funding occurs on your construction loan. Don't go out, don't have your buddy that's the excavator, don't go out and think that you're just going to do a little bit, because what's going to happen is when the title company goes out, they're going to see that and they're going to worry and they're going to panic and they're going to have to check the SCR again and it's going to delay things. So just do your best to don't start construction. Don't incur any new debt or increase your current debt during the course of construction. This is probably the single hardest thing that our members have faced while they're building homes. It's so easy to go to our Home Depot. I'm going to throw all the locals out. Home Depot or RC Willey and buy your things on credit. And oh, if you open an account with us, you have 12 months, no interest. And if you need to do something like that, just check with your mortgage consultant and make sure that it's not going to affect your ability to qualify for the long term. I'm not going to say that it's impossible, but we really have run into several situations where people have gone and they've gotten into additional debt through the course of construction, and we haven't been able to get them qualified for the long-term takeout. That is a really hard thing when they're not even qualified for the home that they've just built. It can be devastating. So just keep your mortgage consultant included as much as you can. Don't change your income. It doesn't mean that you can't change jobs. We have a lot of people that are, getting opportunities that are presented that are better opportunities, and we don't want you to miss out on that because you're building a new home. We want to help you through it. So just have those conversations with your mortgage consultant. And lastly, don't deviate from the plans and costs that were submitted for approval. It's really easy to get carried away when you're building a new home, and it's really easy to look at that line item. I can give you an example personally because I had a line item for appliances that was $5,000, and I went shopping and saw this refrigerator that was like $4,500, and I thought that it was just like the best thing ever and needed it, and I didn't stop to think that my budget was $5,000, and if I went over that budget, I needed to cover that out of pocket. I was just thinking that I was just going to submit the invoice and have it taken out of the construction loan. Well, that's not how it works. If you deviate from those, if you go over in those line items need to be covered. And if you only have X amount and you need more than that, you're going to need to cover those costs through the course of construction out of pocket. So make sure that you stay to those plans and costs as much as possible. And again, it doesn't mean that there's no opportunity for increasing, but you need to have those conversations with your mortgage consultant and make sure that you address those. So that's pretty high level, and I know that we've got a couple more questions, and so I'm going to go ahead and answer a couple more questions.
Mark asks, when do we lock in the loan rates for the 1 and 2 time close option?
Okay, so those are really good questions. So thank you for asking that. To lock in your interest rate for the one-time close, it's actually locked in on the front end before you sign your documents. We commit to that rate. Those rates are a little bit above market because we are committing for whatever the term of construction. If it's 6 months, 9 months, 12 months out, we have to kind of guess what the market's going to be. And so we commit on those. You are locked in before you sign your documents. On the 2-time, we will actually wait until you have the certificate of occupancy to lock in your rate for the long-term loan. The reason for that is we lock typically on a 45 to 60-day lock, and the certificate of occupancy can be completed without flooring, and we really need it to be 100% complete. We have to have the final inspection by the appraiser. So we require the certificate of occupancy to be completed before we lock in that rate, just so that there's not too many delays and then you end up having to pay for extensions on the lock and everything else. We go ahead and ask you to have that certificate of occupancy. It was a good question. Thank you. Hope that answered it. Any other questions?
Let's see, any fee for early payoff?
There is no fee for early payoff on any of the loans that we do. I can tell you that all of these long-term loans, the construction loans, the long-term takeouts, any of those loans that we do not have any kind of a prepayment or early payoff fee. I can go as far to share with you that the only loans that have any kind of an early closure or early payoff are our home equity lines, and we don't handle those. Those are handled through our consumer department. Those, and the only thing that we ask you to pay, because there are no fees on those, if you close it more than 2 years or sooner than 2 years, we ask you to cover whatever the costs were, just because those are expenses that we pay on your behalf, and it takes us usually about 2 to 3 years to recoup them. So that's a really good question too. So one of the questions that we get asked from time to time is, what happens if we go over the costs? Bet you guys haven't heard that over the past year, that costs are higher than what you expected or costs are more. What happens if you go over? We try, and we have in our construction loans, we require that there is a contingency line item. We put a 5% contingency line item on every single construction loan, and that is part of the loan. And so if you have unforeseen expenses, unforeseen emergency expenses, we would go as far to say, typically that contingency line item helps you out with those things. And that's what we do it for. We require those. So hopefully that helps address some of the overages. One of the other questions that we get to are our credit scores. What's the minimum credit score requirements? And that's something that we didn't address last meeting. Why didn't I address that? But minimum credit score requirements is to get you qualified for the long-term takeout. If you're in conforming limits, 640 or higher is a required credit score in order to get you qualified. If it's in jumbo, then we're looking at 700 or higher. In a few case-by-case basis, we may be able to do lower than that, but it depends on getting you approved for that long-term takeout, making sure that we can get you out of this loan that we're looking at getting you into. I addressed with you that we do 6-month, 9-month, and 12-month terms, but what I didn't address is if we need longer time, because, you know, unforeseen delays, because we've all seen those this past year too. Not only the increase in prices, but unforeseen delays. And that happens, and we recognize that. So we do offer extensions. We offer an extension for 3 months at 1/4 point of the loan amount, not the balance, but the loan amount. So whatever the original loan amount, 1/4 point for 3 months is what we charge for extensions. And we like to make sure where we're at in the stage, we really don't like to do less than a 3-month extension. That is our rule of thumb. Typically, if you're just 2 weeks out or 3 weeks out, we'll still ask you to do that because we've had some of the cities take upwards of 3 to 6 weeks to do certificate of occupancies. And so our extension policy is 1/4 point for 3 months. But those are all good questions and good information to share. Any other questions?
We're out.
Okay, I appreciate your time. Thank you so much. You've had great questions. You've had great perspectives on these things. If you have questions, reach out to the mortgage department at the 801-481-8840. That's a mortgage consultant will answer. They can help you through the questions. And we look forward to helping you build. Give us a call and let us see what we can do for you. Thank you so much. Enjoy your afternoon.